Most investors see an $80 XRP target as a fantasy. But what if I told you that it is not about hope, not about hype, and not about social media excitement, but about structure, compression, and mathematical probability? Welcome back to We Are Cosmic. If you are serious about crypto, if you are serious about building real wealth through digital assets, and if you are tired of emotional trading and guesswork, then you are in the right place. On this channel, we break down the market like professionals. No noise, no blind hype, just data, structure, and execution. Today, we are not talking about a random price prediction. We are talking about a 7-year structure that has shaped the entire XRP chart. What most people call sideways movement is actually one of the longest compression phases in modern crypto history. While assets like Bitcoin and altcoins pumped and crashed multiple times, XRP stayed inside a defined horizontal corridor. That is not weakness. That is stored energy. Let's understand this clearly. In technical market structure, long periods of tight consolidation do not destroy momentum. They store it. Think of it like a spring. The longer you compress it, the more violent the release. XRP has been compressing inside what many analysts now call the white channel for approximately 2,500 days. That is nearly 7 years of price being locked within defined boundaries. Retail investors look at that and say, it's dead. Professional traders look at that and say, energy is building. Now, here's where most people get it wrong. They think price suppression means failure. But in markets, suppression phases often become institutional accumulation zones, especially when legal uncertainty exists. For years, regulatory pressure kept XRP in a controlled environment. During that time, infrastructure was being built quietly in the background. Spot ETFs are now live. Institutional rails are active. Legal clarity has improved dramatically. So when we talk about an $80 target, we are not talking about blind optimism. We are talking about what happens when a long horizontal base transitions into price discovery. Historically, when multi-year consolidation zones break, the move is not small. It is vertical. But here is the key question. Are you positioned correctly for that move? Because patience alone does not create wealth. Execution does. There is a shift that must happen in your mindset. You cannot stay in a passive waiting phase. You must move into an operational phase. That means understanding exactly where the boundaries of this white channel are, where the breakout becomes valid, and where your risk to reward becomes asymmetric in your favor. The market does not reward emotion. It rewards preparation. Most holders are staring at charts daily without a map. They react to 5-minute candles. They panic on dips. They celebrate fake breakouts. And then they get trapped. What separates professionals from retail is not intelligence. It is structure. There is a specific weekly close that validates a real breakout. There is a specific compression apex where volatility expansion becomes statistically likely. If you do not know those levels, then you are guessing. And guessing in crypto is expensive. Now I want you to think about something very clearly. If $80 sounds impossible to you, ask yourself, are you looking at the chart in percentages or in dollars? Because markets move in percentages, not in your emotional comfort zone. The 2017 XRP breakout was not logical at the time either. It was explosive. Multi-year bases tend to resolve with multi-fold expansions. When you overlay previous cycle structures, the similarities become difficult to ignore. But we are not concluding yet. We are building a case. For nearly 2,500 days, XRP has respected a defined horizontal range. That is not random. Markets do not stay trapped in a tight corridor for 7 years by accident. When price repeatedly respects the same upper resistance and lower support, it creates what professionals call structural memory. This memory becomes extremely powerful once price approaches the apex of compression. Most retail traders misread sideways markets. They assume nothing is happening. But in reality, sideways movement after a major rally is often a redistribution and accumulation phase. Weak hands exit. Impatient traders rotate into trending assets. Meanwhile, capital with longer time horizons positions quietly. Now think about the psychology here. Over the last several years, XRP has tested patience more than almost any major asset. That frustration is not a flaw in the market, it is a filter. Markets shake out emotional participants before they reward disciplined ones. The key concept inside this white channel is compression. Volatility has steadily tightened, highs are capped, lows are defended. Every rally attempt that failed added more pressure, every fake breakout that reversed trapped more liquidity. This is what builds explosive potential. But here's the important part. A breakout is not valid just because price spikes above resistance for a few hours. Professionals do not chase intraday moves. They wait for confirmation. In this case, that confirmation requires a strong weekly close above the upper boundary of the white channel with increasing volume. Volume is critical. Without volume, breakouts fail. With volume, breakouts expand. If XRP closes above the upper boundary on a weekly time frame with sustained volume expansion, that is when the transition begins from range trading to price discovery. Now let's talk about the apex point. As price tightens into the end of a long horizontal structure, the risk to reward ratio changes dramatically. When you are near the lower half of the channel, downside risk exists. But when you are pressing against resistance after years of compression, upside potential expands while downside becomes limited relative to the potential breakout. This is where asymmetric opportunity forms. An asymmetric trade means your potential reward significantly outweighs your potential risk. If XRP breaks out successfully, upside projections expand exponentially. If it fails, it remains within the same channel it has respected for years. That imbalance is what long-term investors wait for. Now, many of you have probably experienced fake outs before. Price moves above resistance, social media explodes with excitement, then it drops back inside the range. That happens because liquidity above resistance gets hunted, stops get triggered, retail buys into momentum, then smart money sells into that liquidity. So how do you avoid becoming part of that trap? You wait for structural validation. You focus on weekly closes. You look for expansion in both volume and volatility together. When those two align, the probability of continuation increases significantly. Another powerful tool here is fractal comparison. When we overlay the 2017 breakout structure with the current cycle, the percentage compression and expansion phases mirror each other in a surprisingly similar way. Back then, XRP moved from long consolidation into a parabolic expansion that multiplied price dramatically in a short period. Markets move in cycles. Human psychology does not change. Fear, disbelief, euphoria, these patterns repeat. When long horizontal bases resolve, they often resolve violently. But let me be clear, this does not mean $80 happens overnight. Parabolic moves include pullbacks, they include pauses, they include shakeouts designed to test conviction. Between current levels and an extended target like $80, there are gravity wells. These are zones where price will likely consolidate. Two major ones sit around $13 and $27. These are not random numbers. They represent high volume nodes where profit taking and hesitation will occur. Most people will sell everything at the first 10x. Then they will watch price continue without them. Discipline is not about holding blindly, it is about understanding the roadmap. Now that you understand the white channel and the potential for a breakout, the next step is asking yourself one critical question. What is your bag built for? Many holders make the mistake of treating their XRP as a single, undefined position. They buy and hold without a clear plan, hoping the market will decide for them. That's the fastest way to lose both money and opportunity. To navigate the coming move toward $80, you must assign a specific role to every token you own. Let's start with the concept of tiers. Every position in your portfolio should have a purpose. Some tokens are for security, your capital you cannot afford to lose. Others are for growth, your long-term play toward multifold gains. And a small portion can be allocated for speculative moonshots. By separating your holdings into these functional tiers, you remove emotion from decision-making and create operational clarity. A simple example, if you hold 1,000 XRP, your strategy might be to secure your initial capital at an early target, say around 13 ARN. Selling roughly 10% at this point allows you to recoup every dollar you put in. This transforms your position from a risk-laden bet into house money. From there, your remaining holdings can pursue the breakout to $80 without the fear of losing your principal. If instead you hold 5,000 XRP, the potential for a sovereign, life-changing outcome becomes real, but the principal remains the same. Protect what you cannot afford to lose first. This is the essence of professional trading. The initial exit does not mean you are missing the move. It means you are designing your position to survive it. Once your principal is safe, the psychological burden disappears, and you can ride volatility with confidence. You are no longer reacting to fear or greed. You are executing a plan. Now let's talk about the mental side. The move toward $80 will not be linear. There will be shakeouts. There will be price corrections. The first major test will occur around $13 and the second around $27. These are not arbitrary numbers. They are high volume nodes where early sellers, retail investors, and traders seeking quick profits will take action. If you are not prepared for these pauses, you might panic and sell too early, missing out on the rest of the upside. Discipline, patience, and a clear exit strategy allow you to see these pullbacks as minor breathers rather than trend reversals. Emotional detachment is a skill, not a personality trait. It comes from education, preparation, and structured planning. That is why channels like We Are Cosmic focus not only on market structure, but also on operational execution. Knowing your tiers, mapping your exits, and preparing mentally allows you to treat a vertical move like a professional. You stop chasing hype. You stop reacting to headlines. You start acting with agency. Another critical tool here is the concept of the 80-20 rule. When XRP finally surges into its parabolic phase, secure 80% of your life-changing gains at preset targets and leave 20% to ride the moonshot. This approach allows you to fund your future and satisfy your what-if without becoming emotionally compromised. The rest of the market will scream, panic, or become euphoric. You, however, remain in control. Finally, security and operational readiness cannot be ignored. As your portfolio grows, moving assets off exchanges into cold storage, preparing legal and tax structures, and having multiple exit points is critical. Extreme wealth requires extreme preparation. You are not just a holder, you are a guardian of your own financial freedom. Now that your portfolio tiers are defined, the next crucial step is protecting what you've built. In crypto, the bigger the move, the higher the stakes. The surge toward $80 for XRP will be violent, and without preparation, even disciplined holders can lose gains. That's why risk management is not optional. It is essential. First, let's talk about liquidity. During parabolic moves, markets can become illiquid. Exchanges may face outages, withdrawal limits may tighten, and order books can be thin. If all your tokens are sitting in one exchange, you risk being trapped. Professionals diversify their holdings across multiple secure platforms. They maintain cold storage for the bulk of their position and use reliable exchanges for active trading or preset exits. This removes the single point of failure risk. Next, consider psychological pressure. When price rises rapidly, emotions accelerate faster than markets. At $5, $10, $20 and beyond, the human brain reacts biologically. Euphoria and fear kick in simultaneously. Without a plan, you'll be tempted to sell too early or too late. This is where the 80-20 strategy becomes invaluable. Securing 80% of gains at preset targets shields you from panic, while leaving 20% for the moonshot maintains optionality. Another essential tool is hedging. Hedging doesn't mean betting against your position, it means reducing exposure to extreme downside risk while maintaining upside potential. One practical way is using partial profit taking at intermediate levels. For example, if the first major gravity well is at $13, selling a fraction of your holdings there locks in capital. The same applies around 27. Each sale secures a piece of the position, allowing you to ride higher without emotional stress. Security also goes hand in hand with strategy. A large position hitting 7 figures becomes a target for hacks, scams, or human error. Cold wallets, multi-signature security, and encrypted backups are not optional. They are mandatory. Additionally, tax planning must be in place before the move accelerates. Capital gains taxes can dramatically impact net profit if left unplanned. Professionals plan exits and tax allocation in advance to avoid last-minute panic selling. Operational discipline is equally critical. Have a checklist ready, custody, sell orders, mental readiness. Know your targets in advance. Write them down. Treat them as rules, not suggestions. The market does not negotiate with emotions. It only responds to triggers. By having your operational plan fully defined, you remove chance from your decision making. You are no longer a passenger in the market. You are the pilot. Now let's address volatility management. Between current levels and the apex of a parabolic move, XRP will experience sharp swings. 10 to under 15% corrections within hours or days are normal. Without a roadmap, retail holders panic and sell at these micro dips. Professionals see these fluctuations as normal breathing within a vertical trend. By understanding where the high volume nodes exist and the $13 and $27 gravity wells, you can maintain discipline and even use these dips to strengthen your position strategically. Finally, combine all these elements, diversification, hedging, mental preparedness, and operational readiness to create what I call a wealth shield. This is a framework ensuring that no matter how the market behaves, you protect your principal, secure gains, and maximize upside potential. The wealth shield is not reactive, it is proactive. It is the difference between surviving the parabolic phase and becoming another story of missed opportunity. Now that we've covered portfolio strategy and risk management, it's time to focus on the technical signals that confirm a real breakout. Understanding structure alone is not enough. You need concrete, actionable validation before committing your capital fully. The first tool professionals use is the weekly close. XRP can spike intraday, but what matters is the weekly chart. A true breakout occurs when the price closes above the upper boundary of the white channel on a weekly basis. This is not speculation. It is confirmation that institutional money is actively participating and that the compression phase has ended. Intraday candles are noisy and can trap retail traders. The weekly time frame removes this noise and shows sustained momentum. We analyze volume expansion. Volume is the fuel behind price moves. During the years of horizontal compression, liquidity was quietly accumulated. A breakout accompanied by low volume is often a fake. When volume surges alongside price breaking the channel, it confirms that the move is supported by real buying pressure, not just speculative hype. Professionals watch for volume spikes that match or exceed previous multi-year highs, signaling institutional participation. Fibonacci extensions are another critical tool. They allow traders to project potential price targets based on historical moves. Using the 1.618 and 4.236 extensions, we can estimate where parabolic runs are likely to reach before a major correction. In XRP's case, these extensions align closely with previous cycle patterns, showing potential levels where profit taking may occur. For example, the 1.618 extension often corresponds with the first major gravity well, around $13, while the 4.236 extension aligns with higher parabolic targets, including the $80 zone. By plotting these levels in advance, you create a roadmap instead of guessing. Now let's discuss apex points. This is the moment of maximum compression in the white channel where volatility is about to explode. Identifying the apex allows you to prepare operationally, set alerts, position your orders, and mentally commit to your exit strategy. At the apex, risk-to-reward ratios favor those ready to act, and waiting too long can mean missing the optimal entry or exit entirely. Another critical confirmation tool is the high-volume nodes within the channel. These are price levels where trading activity historically clustered. In XRP's case, $13 and $27. These zones act as natural pauses or temporary resistance points. Understanding these levels lets you avoid panic selling and plan partial exits, ensuring that you capture gains without losing participation in the overall trend. Technical sovereignty also comes from overlaying previous cycles. When we compare XRP's 2017 breakout with the current 2026 structure, the horizontal compression and percentage expansion are almost identical. This fractal relationship suggests that once the white channel is breached, the following move will likely mirror the vertical trajectory seen in 2017, adjusted for market dominance and liquidity. This is not guesswork. It is historical pattern recognition combined with current market structure. Finally, triggers and alerts are the operational side of technical analysis. Once weekly close, volume, and apex signals align, your position should be fully defined. This is when you shift from monitoring to executing. Your tiers, your 80-20 strategy, your wealth shield, all these tools come together. You act on predetermined signals instead of reacting emotionally. In summary, technical confirmation is about filtering noise, validating institutional participation, and aligning your execution plan with mathematically probable moves. With these tools, you are no longer speculating on headlines or social media hype. You are following the logic of markets, geometry, and historical patterns. Now we arrive at the final step, turning analysis, strategy, and technical signals into real-world execution. Understanding structure, portfolio tiers, and validation tools is critical, but none of it matters if you are not mentally and operationally ready. The surge toward $80 will test more than your portfolio. It will test your discipline, patience, and decision-making under pressure. The first psychological factor is emotional discipline. During parabolic moves, euphoria and fear hit simultaneously. When XRP moves from $5 to $20 in days, it triggers a biological response. Without preparation, you may sell too early, lock in partial gains, or get trapped by greed. The professional investor maintains perspective. You follow your predefined exit tiers, your 80-20 plan, and your wealth shield. Emotion becomes irrelevant because your strategy dictates your actions. Timing is everything. The white channel has a finite window. Its apex represents the moment where volatility is about to explode. Waiting too long or entering too early can reduce your reward or increase your risk. That's why operational readiness is as important as technical analysis. Have your alerts set for weekly close confirmations, high volume nodes, and Fibonacci extension levels. Know your entry triggers, partial exit points, and ultimate targets before the market starts moving. Execution is the final step. Every position in your portfolio should have a clear role. Your security tier protects principal, your growth tier captures parabolic upside, and your moonshot tier maximizes exponential gains. Once triggers align, act decisively. Use pre-planned orders, maintain liquidity across multiple secure platforms, and keep cold storage for your primary holdings. Avoid making impulsive decisions based on temporary volatility or social media chatter. Operational preparation also includes legal and tax readiness. Massive gains attract attention. Plan ahead to ensure that selling your XRP does not create legal or financial complications. Prepare documentation, split your holdings strategically, and have contingency plans for unexpected events. Professionals understand that peak gains can be lost in minutes without proper planning. Another key factor is mental rehearsal. Visualize the move before it happens. Imagine price reaching 13, 27 and beyond. Plan your reactions. Know when you will take partial profits and when you will let positions ride. This preconditioning reduces panic, helps maintain discipline, and ensures that your actions are driven by strategy, not emotion. Now consider the bigger picture. XRP is not just a speculative token. With spot ETFs live, institutional rails active, and the ledger handling massive liquidity, this is a systemic market event. The math of the white channel, combined with historical fractals and geometric probability, points to a high likelihood breakout. This is not hype. It is preparation, alignment, and execution. Finally, the choice is yours. You can be a passenger hoping the market decides in your favor, or you can be the pilot, guiding your actions with data, structure, and discipline. Write down your 3 sell targets today. Secure your principal. Define your wealth shield. Prepare for volatility. Set your alerts. Once you act decisively, you can watch the move with confidence, knowing you are prepared for every scenario.